Okay, let's just jump right into it. If you have ever opened up a trading app on your phone, you are instantly hit with those blinking red and green numbers, right? I mean, it kind of looks like a giant casino. But behind all those flashing screens is the actual, literal engine of the global economy. Welcome to this explainer, where we are going to uncover the hidden mechanics behind those numbers. Today, we're cutting through the noise to understand the true meaning of stocks. We're going to see exactly why companies sell pieces of themselves, where your money actually ends up, and how understanding this whole shebang completely changes the way you look at investing. So there is this massive paradox right at the very heart of the stock market. Think about it from a founder's perspective. You spend years, maybe even decades, pouring your absolute blood, sweat, and tears into building a highly successful business. And then, right at the exact moment it's finally worth a huge amount of money, you turn around and just sell chunks of it to complete strangers. Why on earth would someone give away pieces of something so immensely valuable? Well, to answer that, we have to look at the massive hurdle every single growing business eventually runs into. Whether it's to build a massive new factory, hire a bunch of engineers, or open new stores, a business that needs cash really only has two options. You can either borrow the money or you can sell a piece of ownership. Let's look at debt first. If a company takes out a bank loan or issues a bond, it is making a really heavy promise. You have to pay that money back with interest on a strict schedule, and the bank doesn't care if your business is booming or totally crashing. That is high risk. On the flip side, there's equity. That means selling shares. The company gets a huge influx of cash and literally never has to repay it. Zero repayment pressure. But the trade-off? The founders give up a slice of ownership, a share of all future profits, and suddenly, these new shareholders get a say in big decisions. Now, as you'll see, most large companies end up using a mix of both. And this fundamental trade-off is what builds up to an event you hear about in the financial news all the time, the IPO. You see, initially, a company's shares are held super tightly by a really small circle. We're talking founders, early employees, maybe some venture capital funds. An initial public offering, or IPO, is the precise moment a company sells its shares to the general public for the very first time, and they get listed on an exchange like the NSE or BSE. This does two huge things all at once. First, it raises fresh, new money for the company to actually use. And second, it finally gives those early backers a way to turn years of paper wealth into real, hard cash by selling some of their existing shares to the public. But honestly, money isn't the only reason a company does this. Going public is a massive, game-changing, strategic move. Sure, raising cash is the big headline, but an IPO also gives a company a very visible public valuation. It literally turns its own shares into a currency that it can use to buy up other businesses. Plus, it brings serious prestige and credibility with lenders and customers, and it's a fantastic way to reward your most loyal employees with stock options. But, there is a serious catch. All that prestige comes at a steep price. Public companies face heavy, exhausting regulations. They have to disclose their financial numbers every single quarter, and suddenly, those founders have to answer to thousands and thousands of everyday shareholders. Okay, to really grasp this, let's take these abstract financial concepts and ground them in a relatable, real-world example. Picture this. There is a fast-growing chain of local coffee shops. The founder currently owns 100% of the business, and she's crushing it with 20 really successful outlets. But she has this massive, ambitious vision. She wants to expand aggressively across the country and open 200 more locations. Now, to pull off that kind of massive expansion, she obviously needs cash, a lot of it. Specifically, let's say she needs 500 crore rupees, which she simply does not have sitting in the bank. Now, she could go to a bank. Actually, scratch that. A bank loan of 500 crore would just completely bury her business under a mountain of fixed interest payments. The risk is just way too high. So instead of borrowing, she decides to take her coffee company public. She orchestrates an IPO, issuing brand new shares to the public to secure that 500 crore without taking on a single rupee of interest debt. To get that 500 crore financial fuel, the founder makes a very calculated trade. She gives away a 25% slice of her company to public shareholders. And yes, those new shareholders will now get to share in the company's future profits forever. But look at this. The founder still retains a controlling 75% stake. She gave up a piece of the pie, sure, but she did it to get the exact fuel she needs to make a pie that's 10 times bigger. If her expansion plan works, her 75% slice of a massive national coffee empire is going to be worth significantly more than her 100% slice of that original, tiny 20-store chain. That right there is the absolute genius of equity. All right, lean in for this next part because we are about to reveal a major misconception. This trips up almost every single beginner who downloads a broker job. When you log in on a random Tuesday and you buy shares of a company you absolutely love, where does your money actually go? Let's break down the actual flow of the cash here. In the primary market, which is the IPO, when our coffee shop founder issued shares for the very first time to raise that 500 crore, that money flowed straight into the business's bank account to fund those 200 new outlets. But then you have the secondary market. The day after the IPO lists, when regular investors start buying and selling those exact same shares among themselves on the exchange, the cash only changes hands between the investors. So here is the ultimate aha moment. The company doesn't get a single rupee of your everyday trades. No way, right? When you buy a share of a stock on your app, in the secondary market, you are not directly funding that business. You are simply buying that slice of ownership from some other investor out there who just decided to sell it. The company already got its money back during the IPO. Most of your everyday trading is just funding other investors, not the business itself. Let's zoom out a bit and scale this concept up to see just how massive this mechanism is in the real world. In the 2025 calendar year alone, Indian companies raised a staggering 1.95 lakh crore rupees. That is fresh capital flowing directly into businesses through the primary market, allowing them to expand, build factories, and innovate, entirely without the crushing weight of bank loans. And this isn't just some financial sideshow. According to Business Standard's year-end tally, it is a booming part of India's core growth story. Just look at the numbers. In 2025, there were 373 total IPOs. For the first time in 18 long years, more than 100 companies listed on the main board in a single year. And behind every single one of those hundreds of listings was a real business, making the exact same trade-off as our coffee shop founder. They're all trading a slice of ownership for the capital they desperately need to grow. So what does all of this actually mean for you? Well, knowing exactly why companies sell shares fundamentally sharpens how you value them. You need to start reading the market like an owner, not like a spectator cheering at a horse race. An IPO isn't just some guaranteed jackpot. Once you see that a company is selling shares to fund its future, you start asking much better questions. You start evaluating those shares based on how the company actually plans to turn its newly raised capital into bigger long-term profits. So, I want to leave you with a highly actionable mental framework. The next time you spot a hot new IPO making headlines, play detective for a minute. Seriously, take 2 minutes and look up the offer document. It's officially called the Red Herring Prospectus. It is completely public information. This document actually spells out in black and white exactly where the public's money is going. You don't even need to invest. Just practice seeing the IPO for what it truly is, a business trading its ownership for capital. And as you're skimming through that document, ask yourself the single most important question you can possibly ask as an investor. Are they raising fresh money to actually grow the business and earn more profits down the line? Or are the early investors simply using this as a convenient chance to cash out and enrich themselves at a price they carefully chose? Because great companies raise capital to multiply it, following the money right into the business. That is the true heart of sensible investing. Think about that the next time you see those numbers blinking on your screen.